Hello traders, this is John Kicklighter, Chief Strategist for DailyFX.com, here with a Forex strategy video, and we're going to talk about an indicator that I use very often and I find quite useful for a number of reasons. The average true range, or as you'll often hear it referred to as the ATR, is a measure of activity for the markets. This is very important when we are looking at FX, which doesn't have a centralized exchange and therefore does not have very good volume indicators, and also as a measure of volatility. All right? And a lot of people reference the volatility figures that we like to use in Daily FX. We have access to a number of things. We also have a couple proprietary measured volatility indicators, including the FX Volatility Index, but we can actually use this ATR as a tool that replicates volatility. It's a very good measure of this, in fact, and that in turn can be used into your trading to significantly improve accuracy in terms of establishing when we're having breakout range, trend, momentum development, and a number of other aspects of your trading. So let's take a look at this versatile indicator, and I'll show you exactly how I use it, and we'll look at a particular number of pairs and markets which have some interesting ATR readings right now. The first thing to assess, there are three general states that the ATR can really be used for and improve our trading. One, it measures just simply activity levels. All right, it's important to assess and realize it does have this measurement ability. Two, it actually has sometimes a gauge of directionality to it. Just like implied volatility. Remember, when we look at the implied volatility measure or the VIX indicator versus the S&P 500, those two have a fantastic negative correlation, meaning when the volatility index picks up, the S&P 500 most oftentimes drops. All right, so that's a useful aspect to this indicator as well. And then we also have downshifts and upshifts in volatility. This is important. This is more of the level of changes volatility, which is essentially like saying going from range to breakout, from seeing a trend that is just starting to really gain traction and build momentum over time, or lose that momentum and give you the first signs of an initial reversal. All right, there are many aspects to how we can use this, and far more than what I'm just going to talk about here today, but I'll show you why I find it particularly useful. Now, I think it's important to see the actual indicator itself at work on a particular pair. This is the dollar-yen versus the 20-day average true range. Now, the average true range is calculated in a very simple way. All it is the daily range of every one of the bars that we've had for how many ever days we're going back. This, we're actually going back on 20 days. So we'll take the range of these past 20 days and we'll average it out. So, for example, we can see this session here from Monday was very, very narrow. High and low. All right, you can see it was essentially 30 pips. Wow, it was a really narrow day, really inactive, very quiet. We put that into context with all the other 19 past previous trading days, and you get a measure of activity that looks like this. All right, very, very quiet. And you can see how it's developed over time, and you can change the time frames. This is 20 days, but what if I changed it to a 1-day time frame? All right, I can just alter this. We'll make it 2. Well, let me go down to 1. So 2 trading days. All right. When we take into consideration the Thursday, Friday of last week, huge jump in activity, but then you have today's, which is extraordinarily quiet, just like the prior breakout effort that you had into Thursday, Friday. So it is a good indicator for many different reasons, as you can see just on this one example. But let's take a look through its individual rules. First, I'd like to take a look at just using it as an activity gauge. We looked at it a little bit on the dollar-yen, just only going back maybe 4 or 5 months, but this is an activity gauge for pound-yen, going back over the past 7 years or so. This gives us a very good assessment of this development over time. You can see huge spikes when we did have a very high level of volatility, which coincided nicely with this really big drop. Same with this mid-2010 when things were really starting to deteriorate in Europe. All right, and nowadays we can see that there is more of a positive correlation, which is unusual. All right, we'll talk about correlation in just a second, but you can see once again there's a deviation, a very interesting deviation. All right, and this is a 20-day ATR. Recently, the correlation has been positive, or at least it has been since about the mid 2009. But this is perhaps one of the biggest deviations we've seen since this huge spike to the positive side, though we don't usually see moves to the downside that deviate very long. This is perhaps an indication that conditions are going to change. We change our time frame. This is the average true range of the past 5 days, or one trading week. And as you can see, we are stepping down very quickly, right, for the pound yen. And that's a dangerous position to be in when we look at this kind of congestion. In fact, I have the daily chart of the pound yen up, and you can see that we've worked our way into this congestion pattern, where it's essentially from 159.25 down to the floor down here at 156.75. A very narrow window for this typically very active pair, which even on the 5-day rolling average has a daily range of about 100 pips. So we can cover this entire range within a couple of days, and subsequently this tells us a breakout pressure is coming, a good activity gauge, right? And we can use it as such. This is a ATR in progress of a directional measure. I like to use the S&P 500 as a very good benchmark for this aspect, because it is perhaps one of the more well-known uses of this particular indicator. And that's where the ATR and VIX index are used well in conjunction, because the ATR actually gives very similar readings to the volatility indexes that we typically like to load for you. Now, this is the ATR as it is right side up, so to speak. If I were to flip this indicator upside down, you can see how the big drops coincide, or the big rises in ATR coincide to the big drops in the S&P 500. Why would that be? Well, this is an indication that the declines that we have in the S&P 500 are far more dramatic than the increases. This is how the relationship is between activity, market level activity, and measures or markets that are risk sensitive. So the S&P 500, when you have risk appetite rising, activity levels decline and S&P 500 rises. Right? But when you have a risk aversion sentiment where fear is predominant, there is typically a bigger move to unwind those risky positions, and subsequently there is a big pickup in activity and a drop in the index. Now, this is not just unique to the S&P 500. This just so happens to be also a positive correlation to the same currency pair we were just looking at, the pound yen.